Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus. And today we've got a guru on the show who was on the show before when it was called the Apartment Guys back in the day. That was last November of 21, I believe, Max, was about when we had you on the show last. And Max is crushing it. They're doing big things in the multifamily space, and I'm excited to catch up and kind of get an update. The market is shifted and changed so much since that point in time, since last November.
Yeah, sure.
It makes, today's market makes November's market look like a dream as far as deals and pricing and all that stuff. But Max, before we kind of jump in, man, just give us a quick update. Give us, tell us a little bit about your team and what you guys have been up to.
Sure.
And that'd be great.
No, absolutely. So, when we spoke last, we were a very young shop out of the gate, and, quick background on myself, I'd been in the commercial, institutional multifamily space for many, many years, placed, several $100 million for, several billionaires, as well as, pension funds and, groups that were out putting large swaths of money in the market, both on the high scale down to, I'll call it the syndicated basis. And decided to go out, say, hey, it's time to do this on my own for my own investors with, our network of people who wanted to, be investors in deals. And, and we've been on this new journey during a period that, man, I'll tell you, it's always bumpy, whenever you start. And so when I was on with you previously, we were really fresh out of the gate. And since then, we bought 3 deals here in 2022 and sold one of them, which was a great transaction for us, even on the one that we sold.
So you bought one that you sold, or you bought one and
we bought one and we bought one and we sold. So we bought 3 full deals. We have 2 now, and we sold that third one off right away, right after we purchased it, because we had a buyer who wanted it. Knew what we were in contract on as a value add deal in the Phoenix market. And we were able to move out of that deal, very quickly as a result of, selling to someone else who had, a good business plan to implement, what they were looking to do in that particular market. And, and we're looking for our next deal, right now, and we're spending a lot of our time and resources, working with investors, and that was one thing that for me personally, I had to make a big, investment in was, I had a lot of great deal experience. I had good management experience. I had good asset management experience. I had good debt structuring experience. And, and a lot of good, long-term experience within these assets from a lot of my corporate background. But what I didn't have was, I'll call it, deep access to capital, which is really, we all know, they go hand in hand. If you want to do deals, you got to have access to money to be able to go out and implement those things. So, so a lot of our time right now with this kind of transition in the market has been really focused on, building out that investor database and working with investors who want to, get in the market, and who also are recognizing that, that we're really on, the early side of what will be the next real estate boom once we're through the current recession. And that's something that, there's no secret in the market. Most people are kind of aware of that. And it's a reason that, you and I are both on the phone with guys regularly. We're working on these current deals. And, the comment is, I'm waiting, or that's, the general sentiment that we get. But we are, working hard on building out those investor relationships. So, that's the current focus that we've got. So, but that's an update since last year. We've got the deals that we do have are going well. We are ahead of our leasing trajectory for our asset that we bought in Riverside, and our asset that we bought in Phoenix that we still own is really doing fantastically well for us. Also, even within the current market, we still have good collections on both assets, so things are going very well.
So Riverside, Arizona, where is that?
Riverside is Southern California market. So
okay, I knew of that. I didn't know that you guys invested there. Okay, cool.
We do. And I'm still a big believer in the California market, and the California market, it gets shit on a lot, within, a lot of groups say, California, they're worried about regulatory risk, and, there's so much, I'll call it Fox News kind of, punching down on California. However, on the multifamily side and investing in general, California is such a supply constrained market that we still continue to see increasing demand for existing units within the market, because we still cannot catch up with the demand to build new units within the state.
Yeah.
And as a result of that, a lot of, and in addition to that, assets in California also have a fixed tax basis. So, once an asset is purchased, the taxes are fixed, they're not going to go up. And as a result of that, a lot of owners just don't sell. They recognize, even if there's a lateral move, they want to, buy another building, another location, they're going to have to pay, whatever the new amount is for the asset. Taxes are going to go up. And as a result of that, their cash flow is going to get hit.
Yeah.
So you also find that California, in addition to being supply constrained for units for regular renters, you also find that it's supply constrained for owners who want to own in the market, because there's just not the transaction volume in the state of California like you see in other locations.
What size asset is that in Riverside?
It's a smaller asset. It's located near UC Riverside, and it was a 16 unit that we turned into a 17 unit.
Okay.
So it was, and that was a property that we went and we saw, and we didn't know we were going to like it as much as we did. But we got in there and we found out that we could add an additional unit right away, turn into a 17 unit, and two of the 1-bedroom units had a enclosed patio. So it had the roof line actually enclosed the patio, but it was so huge, we could actually turn 2 of the 1-bedrooms into 3-bedroom units. So we were able to actually get significantly increase both our unit count and our floor plan for a smaller property. Yeah. And I generally, my core background within the institutional space was really working in larger assets. I mean, I worked on a lot of bigger deals, within the California market also, which were assets between, call it 35 up to about 150 million. And, if we add 1 unit to some of those properties, there's not really that much of there is an improvement. I don't want to say there isn't. But if you've got a 4-plex that you're adding additional units, make it a 5-plex, well, that's a 20% increase in value if you're able to do that. And on the 16 unit, we found a pretty good addition to the NOI to be able to add that 1 unit plus the 3 bedrooms onto it as well.
What's your long-term plan on that? My dog's pretty excited about this deal, apparently, barking in the background. But
I love it.
What's your play on this one?
So we
hold it.
So we underwrote for a 5-year hold, and right now that's still the goal. With what's happened within the market for debt across the board, we'll have to make a decision on at what level we're going to plan for a longer term hold. If we're able to secure debt within 5 years, great. If we look at it and we go, hey, to really secure this investment for or for our investors, because we're always making the best decision for the investors. That's really what it comes down to. And if we see that the best decision is to keep a little bit longer, then we'll do so. If we find out that we get a great offer within year 3, then we can make that decision as well. Yeah. But we're finding that still within, this particular market within California, we're still seeing really, very strong rent growth. And again, California, a lot of people kind of, harangue on California, but, the rent growth in the market is significant, and the regulations that many people say, well, California's got rent control and those other things. Those are things that have increased the values of real estate in reality. And I'm not pleased with the way they've gone about it, but I have seen it from a data standpoint where rents have increased as a result of them implementing rent control. And, and I'm not an advocate of rent control. It's this process by which cities recognize that there is a demand from a more affluent body of people to rent out units. And instead of bridging that, and they don't want to have, people who are in their current leases, be priced out of the market, which my heart goes out to those individuals. It really does. But in the sense that the local government bodies are recognizing there's this delta between market rents and where they're trying to force lease rates to be, they're really forcing that delta onto the real estate owners. Mm-hmm. They recognize there's a difference. Now, if the city governments, want to come in and say, hey, we're going to offer rent assistance programs to help these people pay for this delta in rent. Well, I think that's actually a much better way to go about it. But when they recognize there's a delta, unfortunately, cities are then actually catering to not the affluent people who can actually spend money in restaurants and stores and doing all these things that would actually generate the economy. They're catering to the individuals who are not able to do those things. And they're also damaging emerging markets. And what I mean by that, when I say damaging emerging markets, there are many other more affordable markets within the country that would wildly benefit from having new residents move to those locations. But they don't if you end up with cities who are, further maintaining, lower, renter class within their cities. And in so doing, don't have individuals move to these emerging markets that would eventually grow to be the metropolises that they could be. Yeah.
In essence, it's holding down gentrification in kind of both locations, right?
It is. That's exactly correct. It's holding back gentrification in both locations. And again, with rents going up, I definitely care about having rents be affordable for, really everybody. But I don't believe that the methods by which, local municipalities and large municipalities like the entire state of California are implementing those policies, because they're really passing on what they recognize as this delta to property owners by not allowing them to increase rates. Mm-hmm. And that's also based in a system where, there's a lot of, most people don't recognize the amount of money that goes towards debt. Out in the market, that's not something that a lot of people recognize, that how much of the income goes not to the owner of the building, but to the bank. The bank. Exactly.
So how is rent control affecting your particular investment, if at all?
It's not. So, not right now. We've got an asset that, in the rent control within California, the way that they have that structured is it's a CPI increase plus 5%, not to go above 10. And this is just in the state of California in general. So this is not necessarily talking about just our asset, but assets across the board. And the building that we purchased, there was in the rent control law, you are allowed to remove residents outside of the lease if you do what's considered a significant remodel to the asset. Significant remodel is anything that requires a permit to be pulled by the city. Building we bought absolutely had a significant remodel that was attached. We had a roof that was falling down, literally falling down. We couldn't. The previous owner had put on multiple slurry coats on top of it that eventually had caused structural integrity issues for the property. There was a lot. We had to do a lot of work. The property had a lot of work to be done, and as a result of that, we were able to notice residents and have them move out, which we were didn't feel good about. But it was also something that was necessary to actually fix the building. And if we didn't fix the building, the residents weren't going to have any place to live anyway.
Yeah, they'd have collapsing ceilings. It sounds like.
Yeah, it would have caused bigger issues. It wouldn't have been an overall flat ceiling collapse in one fell swoop, but it would have been ponding on the roof in particular locations that eventually would have caused wood rot in between the walls. Those eventual wood rot between the walls would have caused further problems inside the issues for mold or other things like that. So, it would have been this long drawn out, failing of the asset. And, but within those, the rent growth, right now, if it's CPI plus the 5%, CPI is at 8.3, plus 5% would actually get someone over 12. The governor within the entire state caps rent growth at, rent increases at 10%.
Mm-hmm. Mm-hmm.
So, for us within our asset, it hasn't affected us yet. But what we've seen is that there are many owners who have an in-place, tenant, and they're just unwilling to. The tenants are unwilling to move because they know they have a big, increase in rent if they move to another location, and that has constrained supply. That by itself has constrained supply. There's not many available units on the market. And as a result, the units that do become available all of a sudden have a really high price attached to them as a result of supply and demand. And these are the reasons why I'm not an advocate of rent control in general.
Yeah.
So those are the things we see. And then the other issues that we've got in California, it's just a state where, tenant rights are, it can be hard to remove a resident. It can be if a resident really digs their heels in, it can be hard. And again, that's one of those things where, if it ever happens, we don't like doing it, but we'd like to, we don't like doing it ever. But there are times where, there are stories of residents who refuse to move. There was a story that I read about read on the news where it was a resident who, due to the COVID eviction moratorium, sold his personal home. He sold the home that he lived in. And as a result of the eviction moratorium, decided not to move out. And the owner the new owner who owned the house couldn't get him out. Sheriff couldn't move the guy out. And this was an owner who literally just a seller took advantage of the system. And, and that's what is the most upsetting about some of these laws is the question of whether or not it's, taking advantage of the system, or if it's, really a need. And, you hear about this stuff frequently where you've even got, cash for keys programs in cities that have rent control where, a resident will decide to embed, meaning that they got their low income, their low rent at the asset. And they'll say, hey, if you want me out, you got to pay me $50,000 to move me out. Well, okay. So let's again talk about what the value of rent control is. Is it to, keep rents affordable for individuals, or is it an opportunity for people to embed in a particular location, make it difficult to have them moved out, and then have an owner be able to have to pay this individual, a large sum of money to have them removed?
Yeah.
And, and again, this just goes back to my general comment regarding, there's not being an agreement that the government should have as much influx in regards to, business operations as they put their hand into. Yeah. So, because if we didn't have rent control, we would have additional supply. We would not have as high rents as we currently do. And this isn't even just California. I mean, this is any market that has rent control. What these locations need are more units. That's what they need. They need more units. They need more supply. People need to have places to live, and we should be really building more communities. And that's really where the goal should be.
So government could be incentivizing building and development instead of keeping the cap on the rent side of things.
That's correct. That's correct. So so we don't need to go down the rabbit hole on rent control too much, but it's nothing that I'm saying right here isn't I'll call it some known topics within the market.
Yeah. And then so let's talk a little bit about the Phoenix asset. Tell us a little bit about that one.
Sure. It was a small property. And on that particular deal, we bought a property at a 5.4 in place cap in beginning of this year. We got really great debt on the asset, and the majority of the units of that particular property were Section 8. They were HUD leases. And as a result of that, we really liked that property because when we were going into, really a potential, pitfall in the market, with collections being an issue, knew that we were going to have some relatively secure lease rates as a result, because we had the government supplying the back end for those units, or I'm sorry, the rent for those units. And that particular property has performed very, very well for us. We bought an asset that had the opportunity to build an additional 8 units on site if we wanted to. And every unit that was there was a casita style. It was a 2-bedroom, 1-bath individual structure. And we originally, when we bought it, we're planning on moving out of the asset very quickly because the market was just moving so fast, even when we purchased that asset, that we thought we would potentially sell it this year. But looks like we're going to be holding it a bit longer. And now it's cash flowing for us very, very well, which we've been, pleasantly surprised to find on that particular deal, which, we didn't think was going to perform as well as it did. Our Riverside property, that's one that's located in a market where, you really see a lot of hustle and bustle around the location. You see a lot of new things going in. The property we bought in the Phoenix market, not a bad location, but it definitely didn't have what I'll call the local retail amenities and some of the other, I'll call it more affluent things that owners are generally looking for within their renter base. But all those things said, it's really been a great asset. It's performed very, very well for us.
And how is it overperformed? Just higher rents than you thought, or lower expenses, or
primarily lower expenses has been the biggest one. Lower expenses, and because we had a business plan to actually move out a couple of the residents that were there, but we've still seen some really great rent growth as a result. And in my own training background, I just am so cautious on my expenses. I've got generally very high expense ratios, put into my models, because I always want to make sure that we're able to, outperform as opposed to, take a hit to the NOI as a result of not accounting for, the expectations of the operations accordingly on the upfront.
Mm-hmm.
And that particular asset has just done very well. So, we've got for the units that we did lease out, we've been higher than our targets that we originally had, and then our expenses have been lower.
That's awesome.
Yeah,
how many units is that one?
Just 10.
Yeah, 10 units. Okay. So as far as sourcing these days go, tell me a little bit about your criteria, your target markets, asset size, et cetera.
Sure. So, our goal always has been to move into larger assets between, I'll call it 10 to, 25 million is what we're really looking for our next deals. And within where we are in the market right now, if we could find that, markets that we're looking in are Southern California, Las Vegas, Arizona, Utah, Montana, and West Texas.
Okay.
And within those locations, we're definitely looking for opportunities. And it's a little bit of it's a hard time right now. It's a hard time because we don't quite have sellers who are, quite wanting to say, hey, the value of their real estate's dropped, and maybe they don't need to. I'm saying that in the sense of whether or not they've actually seen that in the market. If they don't have, pain in the market, they've got collections that are good, and, the property is, not seeing any vacancy, then they might not need to sell. And they might say, hey, we're just going to keep it. There are other groups that put, floating rate loans on their assets here within the last year, and all of a sudden are seeing wild increases in the cost of their debt. And if they didn't purchase a rate cap, are potentially in a position where they could get kind of pinched as a result of increasing costs of their debt. Mm-hmm. And so we are in general trying to find any opportunity we can within those markets, but we're also looking for smaller assets that we were really originally, when I was we started at the beginning of or end of last year. We were working on smaller assets, but really for the goal of kind of trying to get out of them as quickly as possible. But we also right now are not squeamish about offering all cash offer for smaller assets. If we see an asset that's a smaller property that's cash flowing well, and we can say, hey, here's an all cash offer for this particular property, then we're doing that. And that process is just something that should be done. And if the sooner that we can find a larger assets to make work, I'll be happier with that. But it's it's a tense time out there. There's a lot of institutional capital. We talked about this a little bit before the call, but there's a lot of institutional capital that is definitely waiting. They recognize there's a decrease in values in the market, and as a result, they're intentionally kind of saying, hey, we want to wait until first or second quarter of 23. And there's a lot of news in the market that makes a lot of retail investors kind of spooked. So a lot of the time that, we're spending right now is getting in touch with investors so that, when we find our next deal, we're very quickly able to, raise the capital for that, be in touch with investors who want to, go into the market and recognize that we're really on the early side of the next really big, real estate boom, which is going to really be, starting out whenever this current, phase in the market kind of concludes.
Yeah.
So, so that's where we're spending a lot of our time. You asked about our team. We've got, I've got one marketing assistant. I've got one analyst. We've got my business partner, Conrad, and then we have our construction manager, he's not an in-house person, but he is our dedicated contractor that we work with. So we definitely include him as on the team.
Is he doing both your current properties?
No, he's just doing the Riverside one right now, and we've got some other ones that are in the wings that he's working for us as well.
Yeah. Okay. Awesome. So, and then, when you say you're making all cash offers on smaller deals, what size deals are those?
I'll say anything under about 3 million.
Okay.
And that's and that's very, very specifically, for the right property and for the right value. And that's not for everyone. I mean, there's some properties we look at and we say, hey, we'll offer this particular number. Seller says no. We say, that's okay. And that's fine. And there's other deals that, we're a little bit further along with some of those sellers who are saying, hey, you know what, I'm gonna see if I can get something better. And if they can, we hope that they do. But if not, then, we are looking for value in the market. Mm-hmm. And to some degree, a lot of sellers are a little bit spoiled by the 2021 prices, and there's really, a question of whether or not, that was a true market or was that market, but really as a result of having, the interest rates for debt be so cheap that the real estate values were going up so high and now they're more expensive. We're seeing, a different return on value. And some of which is often the reason that I'll talk to some guys and I'll say, well, what would this real estate have traded for, back in 2019? And because that's the last, I'll call it solid year that we had of, I'll call it normal operations. It was before 2020 with COVID, before 2021, where we had these really low rates. And 2019, if we're looking at, where property values have decreased to, we'll find out here over the next couple of months. And generally, when people talk about decreases in values, I mean, those are things that are often seen in the rearview mirror, even months or years later when someone looks back and goes, okay, here's where the trend line was. And here's where the potential outliers were for good or bad deals. But when you're in the middle of it, market's whatever the building sold for.
Right.
And there's a lot of, well, appraiser says it's worth this, or the seller says it's worth this, or the buyer says this. But the reality is that when you see that data point on what it sold for, to be honest, that was market. That was market at that particular time. And, and we within this market have to, pay attention to all the current cards on the table we're looking at, all of them, the debt constant, what we're returning to our investors or we're offering to our investors for returns, what we have to pay attention to for, risk in regards to potential unemployment or, any of these kinds of factors. I mean, all of those things go into the calculations of or what, for what a deal is going to return and what we're offering to our investors. So, we're looking for more assets that we can purchase right now. And we're looking for, the opportunistic ones.
Yeah. How big would you go at this point? Is there, I mean, if you find a great deal,
if we found a great deal, I mean, it would be, I would really say no limit. If it was $100 or $200 million, then I would love it. And we have resources to go out and place that money. For many of those, types of assets, we just, this is just in regards to growth. And, I'm always fine talking about this kind of thing, but it's, when presenting to capital, we have to make sure that that we've got a track record for them. And, and that might be my experience going back to the corporate side, but, for our own portfolio, we need to ladder that up. For larger assets that are 100 million, I've got several, I've got access to several people who would be, deep pockets of individuals who would say, hey, yeah, let's move forward with this type of, opportunity. So, but on the big game hunting, that hasn't been in normal focus. The normal focus that we're looking at is kind of that, I'll call it $10 million, $25 million asset size.
Yeah. And in terms of, well, let me ask you two questions. I'm just going to drill down on the, you mentioned you have resources to go out and source capital for these larger purchases. Are those family offices? Are they, brokers, insurance companies? What are you looking at there?
It would just be a spread of everything you just named. Yeah. So, everything you just said, yes, is the answer to that. Yeah. So all the above. And, and for good deals, capital, you're able to find capital. That's the rule of thumb is if you find a good opportunity and a good asset, then you can find those things. I have not been focusing on that size of asset and in so doing, those particular groups, and this is, really goes back to presentation of numbers, but when placing money, that much money, whoever is the equity check that's going to be writing the check, they're going to want to vet everything about you and the deal and the underwriting as possible.
Absolutely.
And so if you were to bring me a $100 million deal in Columbus, Ohio, to be honest, I would not be able to raise the money for a deal like that because I don't know anything about the Columbus, Ohio market. I wouldn't have access to the comps in the market. I wouldn't have access to, I'll call it the finger on the pulse of the market, or where, lease rates are going, or new transactions have just occurred, or who the major players are, or the major employers in that market, or, saying here are the last, 20 buildings that traded within the last, year. And this is where the A-class cap rates are trading at, the B-class cap rates, and the C-class for, in place and pro forma for each of these particular types of deals, which are things that when you're placing large sums of money, and we go back to that kind of comment regarding the stewards of capital, at those high levels, if you're the steward of capital for a life insurance company, or for a pension fund, or for a credit union, those individuals are paid to make sure that every I is dotted and T is crossed. And that's the same benefit that we provide to all of our investors, where, real estate's not a passive investment. It's an investment where, you have to have someone who's really paying attention to taking care of it. That was the mantra back in the day was, real estate's a passive investment. As those of us who work in the industry, we find it's not passive at all. It's very, very active. And the benefit that we offer our investors is that they are able to invest in an asset with, a sponsor, myself or you, who's overseeing every risk of the deal and operations of the asset, and also underwrote it and did all of those things that I'm mentioning in regards to a full market assessment.
Yeah.
And those are the same things that have to be done for, those larger assets that are the $100 million plus size deals, where they need to make sure that their money is safely placed. And, and safely placed might mean a lot of things. It might mean that if it's a deal in Ohio, the first thing I do is call Tate and say, Tate, here's this deal in this market. Would you partner with us for this? Because, we know that if we're going to pitch to equity, that we need to make sure that we have the right team in place. And, and those are things that, a lot of people kind of talk about, larger assets or what's required with them. And the answer is whatever is required is what's required. And if you find that, your team is better as a result of bringing on more people who are able to mitigate that risk, then that's what you have to do. And, and that's something that's really what it boils down to for all of this is any group that's going to give cap, I don't just call it give, but invest capital, is going to be risk adjusting their, or assessing risk on the investment across the board. Right. And, and whatever pain point they can point to, if the sponsor cannot fix it, there's your problem. So, you need to be able to fix it, whatever that issue is. Right. So that's my answer on raising capital for large deals, whatever it takes. And you have to make sure you're an expert on whatever market it is, on the analysis. And if there's a pitfall there, then you have to bridge it with someone who is.
How are you talking to your retail investors these days, as far as, you don't have an immediate project that you're raising capital for right now? That could change tomorrow in this business, but you mentioned earlier that you're spending a lot of your time these days talking to investors. What are those conversations? Well, first of all, how do you find those folks, and what are those conversations like?
Conversations are, generally it's word of mouth. We have our current investors, and we have other investors that we're reaching out to. Doing podcasts like this, to be honest, really helps, because we're able to reach out to more people. And, it's the reason that I have to be out there just meeting with people and not just meeting people in person, but, on the internet across the board. We've really had to make a point to up our social media marketing across the board. And then we're currently in process of revamping our website with some exchange pieces that go into exactly how we underwrite deals. So we've got a course online that goes into exactly how to, underwrite a piece of multifamily real estate, which, we're happy to let investors see, how it's done, but also get in contact with us so they can see how we're looking at these deals as well. Yeah. And that's how we're finding a lot of people. The conversations with them, generally is, what are your thoughts on the market? Are you looking to invest sometime soon? Which are very, very, regular comments. And a lot of it is outreach that we just want to make sure, when we do call people up, that it's not an out of the blue call. For the next deal, it's actually, hey, we've got this investment opportunity. We think this is a really good one. We'd love to speak with you regarding, this opportunity. Yeah. And I've been getting more and more calls recently with guys who recognize that they want to be on those call lists for when the market turns. They want to be, positioned to be able to invest, on the next opportunity. They don't quite know when that is, but that's really how the calls are going.
When do you think it's going to be? I know that's a crystal ball question, but what do you think is going to happen?
I mean, I think it's right now. I think even right now is a great time to invest. I really do. And that's why I kind of keep coming back to, if investing in a deal and people are able to, bridge current pain points. Pain point might be they're concerned about, the interest rates going up. Okay, well then fixed rate debt is the better option for that particular, plan. They're concerned about, unemployment or, not being able to collect rent. Okay, well then we're able to, address for that within cash reserves. There are different things that I think are accurate in doing so. I do think that with where the market is and the current psychological sentiment of the investors with reading so much, kind of negative news about how this impending wave is coming. And I see these articles constantly, and I get a little upset with seeing them as constantly as they are, because, well, one, I don't agree with the methods that they're implementing for increasing interest rates to tamper inflation. But I also disagree with them in the fact that they are saying flat out that they are going to create unemployment. I mean, I read an article recently that was really the goal. They wanted to slow the economy down, and so doing create unemployment. And, and those things are things that are hard for investors to get away from. And as a result, the returns, I think, have moved up a little bit, where investors previously might have been, felt a little bit safer about a 12 to 14 for a core plus deal, where maybe those returns have moved up a little bit. Same for the value add. They're concerned about those target lease rates within the value add space. So, but as far as investing, I don't believe that there is, timing the market is, people kind of always say, is a really difficult thing. And someone might say, well, I want to wait till next year. But the reality is they might have just, turned away a 10 to 15% return by waiting, and then had their money lose to inflation. If money is going up by, right. If inflation is going up at 8% and you're waiting to invest until next year at, some higher number. I mean, the reality is a lot of those investors probably lost money within the current, wait.
Yeah. You just lost 10% of the value of your cash by letting it sit.
Exactly. And the upside of where we see the market is going to go after this recession, because the majority of the deals that we're buying or looking at right now and planning on buying, we're not selling them in the next 2 years. We're selling them in the next, 5 to 7. That's the reality of the underwritten hold period. So, and based on that hold period, we should be buying. We should be buying right now. Mm-hmm. And with the inflation doing what it's doing, there's the real possibility that prices will not really materially go down. They might go down from the 2021 price, but people forget very specifically, because people, if there's another recession, I'll buy a house. But then they forget that the reason there's a recession is because people couldn't afford to buy a house. The debt was more expensive. The unemployment was higher. Whatever the people have a kind of a thought that within a recession that, they're going to have money when no one else does. Mm-hmm. And that just isn't the way it works. So things are depressed for a reason. They're always going to be hard, but putting deals together during those hard years are really the deals that look the best in the rearview mirror.
Right. Right.
And
that's why they say millionaires and billionaires are made in downturns like this.
Exactly correct. Yeah. Exactly correct. So, so we're really looking to just be in contact with more of our investors, with frequency. The institutional calls, the retail calls versus the institutional calls are very different right now. The institutional calls, those groups are very intentionally waiting, and you can kind of see it. You see it, they'll tell you. And, even on the debt side, a lot of the companies who are placing debt, they're not even able to say exactly where their rates are going to be. And they're giving out, soft quotes within the market. But once term sheets come back, those things are different.
Yeah.
And they kind of have to be, because, even, requesting an appraisal. And I'm talking with one partner right now for a deal that we're looking at, which I won't talk about too much on this particular call, but the previous owner put on debt on the asset, and if we put on new debt on the property, and this property was just purchased, or the new debt was put on the asset just this year, but if new debt is put on the asset, the question came up: well, is the appraisal going to come back better or worse than it did earlier this year? In which case, if the appraisal comes back worse, the appraiser looks at it and says, I disagree with the previous exit cap, and now we're going to use this new exit cap on the deal, and your after renovated value is this lower number. Well, then you could end up in a really hard spot, on not even getting new loan proceeds as high as someone was expecting because of an outside factor. Right. And So, lenders, they're trying to figure out where they are. The institutional partners are under the same kind of, hey, we got to wait to see what happens with the economy, what happens with debt, so we can actually, underwrite these things accordingly. And on the retail side, we deal with the same factors, but not as much usually with the retail investors, at least. I shouldn't say at least. Generally, we're talking to the decision maker. That's the great thing about the retail investors is when we're talking with them, we know exactly who's going to decide if they want to invest in the deal or not, and that makes that part of it a much easier conversation.
Yeah, yeah. This conversation about apartment investing, multifamily, commercial investing, being a hedge against inflation is like one that everybody should be having right now.
I agree. I completely
us
agree.
At Greenlight, you guys, Max, like all the listeners, like, and if you don't totally grasp that concept, it's really basic. It's just that as the price of living goes up, rents go up. And so the NOI on your property is going to be hedged against the rate at which the dollar decreases in value, right? Or the prices of living and cost of living goes up. And so, even if cap rates go down, you've got some mitigation just from rising NOIs. And then we've been alluding to the cycle kind of coming back and getting us back on a good growth track. At that point, you're loving life. Because your NOI is up, cap rates are now coming back down, interest rates are now coming back down, and you're sitting in such a better place than if you had just, put the money under a mattress and let it sit.
That's really accurate. The faster that we can put my personal money out, really we feel the better. It's actually, I'm really glad you actually brought this up because there's so much kind of conversation around when's the right time to invest. That wave of inflation is truly going to be just further decreasing the value of every dollar in every bank account that is not actually attached to a physical asset.
Yeah.
And as a result of that, I really believe that we need to get my personal capital out as fast as I can. It's really what we're focusing on.
Yeah. Yeah. Hedge it against inflation, get it in cash flowing assets. And if you need a pep talk on that, pick up Rich Dad, Poor Dad. Like,
yeah,
absolutely. Like go back to one of the basics, sacred texts of this space and just get basic about acquiring cash flow assets. They're going to cash flow through the recession, which apartments rents hardly ever come down, if ever. They may flatten, the growth may flatten out or slow, but you're not going to have a decrease in NOI based on rents coming down, like hardly ever. And unless it was some, unforeseeable event. But so yeah, man, this is, dude, I can't believe this. We're up against time here. This has just flown by. For the investor that is in smaller units and looking for smaller units, because that's really where you're spending your, not smaller units, but smaller unit count assets. That's really where you're spending the majority of your time. Seems like these days. What words of wisdom do you have for somebody that's looking for those mom and pop deals at this point?
Well, I guess, unfortunately, I will, we're looking for some of those smaller deals right now, only because we're sure they're transactable. Maybe that's a better way of saying that. We really want to be focusing on the larger assets, 10 to 25 million, which we're, looking through frequently, for those next opportunities. But we know that, as you've even mentioned with your, your Ohio deal, the raising larger sums, it's challenging right now.
Yeah.
It's a challenging thing. But for anyone who's out there and they're, looking to do deals, I guess my words of wisdom are, you got to figure it out. At any way, you got to figure it out. You got to figure it out. And when I say that, be really creative with it. If you've got, you got people and you say, friends, family, hey guys, interest rates are going up and we got to talk about, getting into real estate and buying something. And, and that might sound like a tense conversation, but the reality is that, oh gosh, what did I just hear? I just was listening to a podcast and it said, the cost of success is discomfort. And I actually really loved that too, because there's this kind of statement where, things that are easy, if they're easy, there's not really a win to it. And people kind of say, oh, well, I'm struggling with this, or I'm struggling with that. Well, if you're struggling, hopefully it's struggling in something that's growth oriented, something that's actually, making, you achieve and get better. And, and so whether it's a small asset or whether it's a big asset or whatever it is, but within the real estate industry, we all figure out we have to be creative to work through things. And eventually some of those creative solutions become the normal things that you do, for you, even on this last deal, there's probably a time prior to, you going out institutional capital, that might've been a new call. And eventually you're like, no, this is part of my daily call.
Right.
Those initial tasks become, better. And I'm working with different guys, different places in the US. If you're somewhere within the US, you want to reach out to me because you got some deal you're looking at partnering on or something. I'd love for people to reach out to me on my website. I'm very available on Instagram, very available on our website. And if you've got some deals and you want to figure out how to make them work, or you're figuring out you want to bring some capital in, reach out. I would love to have those conversations, work with anyone who's listening on a deal and figure out how to move the needle forward.
Yeah. And so for listeners, the website is enduruscapital.com.
That is not my website.
Oh, sorry. I'm looking at the wrong sheet. Yeah. Sorry about that, Max. Max, go ahead and give us your website.
Sure.
The correct one.
Website is geometricre.com. That's geometricre.com. And then I'm also on Instagram, _ Max Gonzales _ and available on both of those methods to get in touch with me. And people do all the time. People message me every day. I get new people contact me, and I love being in contact with everyone. So if you want to reach out, please do.
Yeah. And you've got a great presence on LinkedIn as well. So yeah, look up Max on LinkedIn, Max Gonzales. So you will find him for sure. Well, dude, awesome stuff. Totally appreciate you coming back on the show and, sharing your wisdom with us. It's fun just to listen to you because, for listeners, if nothing else, you just got a crash course in vocabulary in this space. Like Max is very eloquent, speaks, very eloquently about this stuff and the terminology. It's like, when you're starting out in the space, it's kind of like going to a foreign country. A friend of mine gave this analogy the other day, and going to a foreign country, you have to learn some of the basics of communication and some vocabulary, like, where's the bathroom kind of stuff, or another beer, please kind of stuff. And that's really true with this space too. There's basic vocabulary, basic terminology, and conceptual concepts that need to be voiced in certain ways and communicated in certain ways. And so Max, you do a great job with all that.
Oh, Tate, I appreciate that.
Yeah. So, awesome stuff, dude. Well, thanks again for coming back on the show. I love having repeat guests. I love being able to catch up and see how things are going, and sure wish you all the best. Keep us posted and let us know how we can be helpful to you guys.
I appreciate that, Tate. Always great being on. I'm so glad you reached out.
Yeah, thank you. And thank you, listeners. Another episode of the Apartment Gurus is in the books, and hope you got a lot out of this. Reach out to Max, and if nothing else, your network is your net worth, right? So every guest that comes on the show is very interested in having you include them in their network, in your network, rather.
Very true. Very true. And, we're all here to get out there.
Yeah. We're not making any bones about it, right? Like, there is self-interest in this pursuit in terms of us promoting our businesses and our platforms and everything else. But we always do try to lead with a tremendous amount of value and really be a contribution to your success in your business. So thank you, listeners. Thank you, Max. And we'll be back on the next episode of the Apartment Gurus. Take care, everybody.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.